everybody, it's Jimmy here with the CLT Life, and today I'm with Delaney Besecker with FBC Mortgage, and we're going to talk about what's going on with interest rates and mortgages and refinancing and home buying and all that good stuff today.
Yeah, well, thanks for having me here today, Jimmy. I really appreciate it. In terms of the refi market, it has dried up. If you check the Wall Street Journal today, there was an article published that mortgage rates, the average rate for the average borrower, primary home borrowing, hit 5% for the first time since 2011. So,
and we're in the middle of April 2022 right now.
Yeah. So it's taken us a while to get there, but I think there's been some payment shock a little bit. I think people, have gotten used to the 2 to 3% that we saw for a very long time, and now the 5% range gives people some anxiety about buying homes. But really, if you look over the course of history from a longer term period, they're not really all that high.
Yeah, I was looking at a chart not too long ago, and it showed for the last 40 years, so basically like from 1980 until now, and I think around 1980 the average 30-year fix was like 16% or something like that, and it's gone steadily down to where in the early 90s it was in the single digits, and I think when we were at 2.5%, 3%, that was actually historic lows.
Yeah, 2.5% to 3%, they were historic lows, and I think we were there just long enough that people got used to that. So I think one of the things that I'm seeing, and maybe you can touch on this a little, is some aversion to buying a home right now. I think confidence in the market is very low, but if one of the things I try to tell my clients is if you expect rates to increase and if you expect rates to be higher in the future, then now is still a good time to buy.
Now is still a good time. Yeah, so what I'm seeing is home values appreciated so much in the past year. So, a couple years ago, high 4s, mid to low 5s was not at all uncommon, but we were playing at a lower price point. So what I think it's doing is it's forcing some people to lower their price range a little bit. So maybe someone was looking for a home in the 600,000s, maybe now they're looking in the 500,000s.
Right, and I think that does a little bit of damage on home buyer confidence as well right now. But everybody's in the same boat, and part of the reason we are where we are is because we have been underbuilding since 2008. So we lost a lot of builders in 2008, 9, and 10, and they either left the industry or maybe they got back into it slow and eventually decided to leave. It was tough. It was a tough time for builders.
And there's been a lot of consolidation in builders too, even just in recent years with companies acquiring one another and becoming these big behemoth builders.
Yeah, absolutely. Yeah, so I don't know that we will see a decline in home values anytime soon. I think we are in the situation that we're in because of a very simple function of supply and demand that became a little bit unbalanced. We had a kind of trifecta coming out of COVID, where one, we were coming out of COVID, people wanted to buy houses again. 2, millennials are now at prime home buying age. So we had an even further influx of people looking to buy homes. And 3, we haven't been providing the supply of new homes that we should have been since 2008. So that has created a situation where we have a lot more demand than we do supply. So back to what we just talked about it not necessarily being a bad time to buy, we don't really see home prices coming down or having a big crash in the near future.
Now you're talking about millennials just now. Are you seeing a lot of applications with first-time home buyers still, or has that slowed down with interest rates going up?
We still see the applications. I think we have just as many applications as we did when rates were a little bit lower. Definitely you see some elongated conversations with those clients, real estate agents, about what they can really afford. And of course, we're part of that conversation as well. Yeah,
well, one of the things that's happening is, and I'm working with buyers who maybe we started our conversations a couple of months ago. Maybe they're in a lease in an apartment, so they weren't planning on actually buying until into the summer. And when they first talked to a lender, they were getting approved in the 3s, and now it's up into the upper 4s and maybe even
Yeah.
above 5. So
Yeah.
they're having to adjust we're having to adjust a little bit what they're looking for
Right.
as far as their home search.
Yeah, and there in the future should be an opportunity to refinance. Rates are cyclical. The market is cyclical.
Mhm.
So if we're talking about a couple extra $100 on a payment that would be comfortable over a maybe not a lifetime, but a shorter period of time, maybe the strategy is to get into a house and maybe cut back in some other areas of a budget and wait until things turn around and then refinance.
Right.
But of course, the risk with that strategy is you don't know when that's going to happen.
Yeah. Are you seeing more alternative products like ARMs? Are you seeing people trying to do that? Because those interest rates are a little bit lower than the conventional, correct? But then you have the risk of them going up.
They are. ARMs are a great alternative product, and alternative may even be a stretch to describe them because they are conventional products.
Okay.
They're a great option, especially for people buying a first house that they may not stay in for 10 years. There are 10-year ARMs available, which have a 10-year period where your rate is fixed, and then the rate will adjust. Nowadays, these ARMs, they have caps, so we're not necessarily going to be worried about going from a 4% rate to a 15% rate the first time your ARM adjusts. There are also shorter time period options available, like 5 or 7 year ARMs. You can even find 3-year ARMs out there. But I think 5 to 7 year ARMs right now are a great option for someone who's buying a house that they may not be in for a very long time.
Are people even refinancing into those products too?
I haven't seen a lot of refinancing into ARMs right now. The refinance boom happened in late 2020 to early 2021, most of 2021 actually.
We refinanced at the end of 2021, I think it was. No, end of 2020.
Yeah.
We refied.
Well, most people got that done.
Yeah.
And
we got under 3, thank goodness. Yeah.
Right. Yeah. So anybody who refied during that time period the ARMs aren't attractive enough to fix something that they may have done in 2020 or 2021. But
Gotcha.
the ARMs are a great product, and I highly encourage anyone looking to buy a house to speak with their lender about those options.
Okay. Now I'm going to ask you a question that you probably get all the time. I get it too, even though I'm not a mortgage professional. Everybody wants us to have a crystal ball and to predict what the future is going to be. So, and I know I read stuff, you read stuff, you keep up with it probably closer than I do. What do you think is going to happen with mortgages, with mortgage rates as we move forward through the year, as the Fed has a couple of more interest rate adjustments throughout the year? Your best estimation, because obviously you don't have a crystal ball.
Right. I don't. If I did, I'd probably be a bajillionaire on an island somewhere right now. Yeah. But I do expect rates to creep up a little bit as we move through the year. Most of that will be driven by an uncertainty over what the Fed plans to do for the rest of the year. We're fairly confident that we'll see a 50 basis point rate hike at the Fed's May meeting, and more than 50% confident that we'll see another 50 basis point rate hike at the Fed's June meeting. What I will say about the Fed's rate hike plans, currently they expect to implement 6 additional rate hikes throughout the course of this year.
Okay.
They've already got 1 done. And a rate hike generally occurs in 25 basis point increments. So if we get to a 50 basis point hike in May, that's considered a double rate hike. So that takes care of 2. Now, what I'll say about the Fed's plans is they generally trail their expectations for rate hikes. So, will we get all 7 rate hikes that they predicted for this year? We may not. We may. I think one of the things that is a very strong factor, a supporting factor for them actually getting everything done, is the fact that inflation is at a 40-year high. That we haven't seen it in 40 years.
And that's the reason that they're doing these interest rate hikes, is to try to get that back under control. Because I know that the cost to borrow money got so low because they were trying to keep, especially with everything going on with COVID early on, they were trying to keep the economy humming along.
Right.
So they lowered those interest rates.
That's right.
So talk too briefly about, I know I always hear there's not a direct correlation between the federal interest rate and mortgage rates. I always hear it has to do with the 10-year Treasury bond. So when we see a rate hike with the Federal Reserve Bank, does that automatically mean that there's going to be a corresponding increase in mortgage rates?
So that's a very good question, and the answer, unfortunately, is very complex. The 10-year Treasury is a great benchmark rate to track. Generally, when the 10-year Treasury increases, you will also see an increase in mortgage rates. Now, that increase may not be point for point,
Right.
but they generally trend in the same direction. The Fed, when they manipulate the federal funds rate range, what that does is it affects the cost that banks can borrow money from each other or lend to each other. And that, of course, when the rate moves up, their cost of funds moves up as well. So they kind of pass that cost on to the consumer in the other ways, like
Right.
mortgages or personal loans, car notes, things like that. So, if we get a 25 basis point rate hike, that doesn't necessarily mean that the 30-year mortgage rate will increase by 25 basis points, but you can pretty much assume that it would trend higher. Now, another item that we're watching that it isn't really talked about a lot, but the Fed has a balance sheet that they plan to unwind. That balance sheet is made up of many assets. A lot of them are mortgage-backed securities. So they're purchasing all these assets every month or every quarter, and they are trying to pull back on how much they purchase. Now, what that does is it creates more supply of mortgage-backed securities in the market. We will find buyers for those products, but we have to entice them to buy more than they normally would, because they all need to be bought up, right? So what that does is, it puts upward pressure on the rate so that those securities are more attractive for people, so they will buy more. So we have two things going against mortgage rates right now. One is the rate hikes that are scheduled by the Fed or assumed to be implemented by the Fed at their future meetings, and two is the unwinding of their assets, their balance sheet.
Gotcha. So we're talking about all these things with interest rates going up and homes being more expensive. Sounds like we're talking about a lot of doom and gloom. What are some positives, though, you see in your industry right now?
Yeah, that's a good question. There's a lot of building going on. I think that we are aggressively tackling the supply issue right now. It's a great opportunity for someone who wants to be a brand new homeowner in a brand new home. I do also think that for those who are looking to invest, it's a great market. You can ride the equity wave in your current home.
Yeah.
A lot of people executed cash out refinances and used that equity in their existing home to buy other properties. We saw a huge influx in second home purchases and investment properties through 2020 and 2021. Has that market dried up a little bit? It has. We have what are called LLPAs on second home mortgage rates right now that make them very expensive. That was a result of Fannie and Freddie being like, hey, let's try to make this a more attractive market for the first time home buyer or the primary house home buyer. So has it dried up a little bit, but it has opened a door for people to kind of dip their toe into the investment space or maybe even have a second home. For anybody who wants to stay in their house, this is a great time. They've ridden this equity wave that has kind of been unprecedented.
Yeah.
The appreciation in home values we've seen over the past year is huge. So, that's going to be a great asset for them later when they do eventually decide to move.
Or even if they want to do home improvements on their home, if they want to take out some
Absolutely.
cash to finally upgrade that kitchen or the bathroom or add the pool or the dream backyard too. But then if they do that, then they're refinancing at whatever the new rate is, correct?
Well, there are other products available. Home equity lines of credit would be a great alternative for someone who has a good mortgage rate and isn't willing to give that up. Those are great products to do home renovations or maybe, put in a driveway or something you want to do.
Nice.
Yeah.
Well, Delaney, thank you so much for spending a few minutes with us. I really appreciate it. It's been very informative. Hopefully it's been entertaining as well. And if I can just give you an opportunity to give a little plug for yourself and your business, where you are, what you do and offer, how people can get in touch with you, things like that.
Yeah, absolutely. So I work for FBC Mortgage, as Jimmy already introduced me. We offer a slew of programs for all types of borrowers. We have first-time homebuyer programs, investment programs, regular conventional loans, government loans as well, like FHA and VA, USDA programs. So if you're in a situation where you need to be a little bit creative on how you can buy a house right now, which most people are, we can certainly help. And should I leave a phone number? I'm not
Yeah, phone number, social media, anything like that.
Absolutely. So you can contact me via call or text at 404-310-5055 at any time. Maybe we can post an email in the comments.
Yeah, and I can put your information up here on the screen too.
Absolutely.
So.
Well,
Awesome. Well, thanks so much for spending time with me. Thanks for watching if you made it to the end. Again, I'm Jimmy Grapponi. This is the CLT Life. I'm a local realtor in North and South Carolina with JPAR Carolina Living, and we'll see you on the next video. Take care.